Did you know that there is a simpler way that you can actually start trading without having to translate a lot of chart in a traditional way? And if you haven't actually noticed yet, I have spoken, I've preached about it, I would say. I've preached about it in so many ways and in so many of my videos. And I just want to make an official video primarily in regards to that. And that one way is using what we call Heikin-Ashi. So, to begin with, let's get started. If you haven't traded with Heikin-Ashi yet, Heikin-Ashi is a Japanese word that translates to average price. So in this case, we are trading with Heikin-Ashi, which is a different way that the system recalculate these patterns that we see in the chart, the opening, closing, and the average, and all that in a very specific way. It then gives us a smooth version of the same chart that we would be looking at on a regular candles. So to begin with, if you're on a trading view or whichever trading platform you are using, try identifying where your where your candle types are located, or bar style is what they're calling it in trading view here, which is right where I'm pointing at the top of my screen. uh, Click on that and you will see a drop down. In a drop down, just look for Heikin-Ashi. I have favored it. It's one of my favorites, so you can check that box if you want to use it. And then once you check that box, or click on that star, and then just click on the Heikin-Ashi itself, that will change your entire chart, so that you can see this chart in a different way. One of the key things that I want to point out in this video is specifically or primarily how you enter a trade, how you exit a trade, how you stay in the trend, or how you stay in the trade, to know if the trade is going to be, if the trade is going to last or not. Okay, and certain things that you can avoid to cut down your losses. So I'm gonna show you some of those, and um, okay, just to begin, let's take a look at a few key things here that we are going to be talking about. First thing is, I want to remind you there are a few candles that we are already familiar with, and those candles are on a on a, let's transform this back first for a moment. On a regular traditional candles, we have this which is called the doji candles. Candles. The doji candles are candles that looks like this. If I can draw, doji candles are candles that looks like this. Okay, so if you're looking at my cycle here, those are primarily doji candles. They are candles that they have the wick at the top and the bottom is nearly equal, or they are equidistant, meaning that the body of the candle itself is very short, and the length of that body might be equal to the 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 length of the upper wick or the lower wick. But that is not true for highly volatile market, because there might be a position, a point where uh, they are very tight, the body is very skinny, and then that means the upper or the lower wick would be uh, not equal. And here is a perfect example of that. If you look at that, not all of these are equidistant. Okay, so we're just primarily going to be focusing on what we call the doji, or this candles here. And then the other thing that we're going to be utilizing to help us make a better trade is what we call the wick. By a wick, I mean, or I am referring to the tail. Okay, the tail of this long tail of a candle, either at the bottom of it or at the top of the candle. Okay, at the top of the candle. Here there's a short wick at the top, but let's use this as an example, as another example, which means, okay, this thing is not acting up. All right, let's use that green one as a top as a top wick. But then in addition to that, let's actually find a better one. Here is a better candle, or here is a better candle, and here is actually a great candle. Okay, let's use this red one here as a perfect example of what we're going to be using today. Okay, this this candle I've drawn in ellipse is what we will be using for most of the time, and this is what would also translate to us some of the dojis that we'll be interacting with. Actually, let me extend it, grab the neighbor here, right there. Okay, let's say those three candles that you see there describes everything we want to know about when to enter a trade, when to exit a trade, and as well when to stay in the trade. Okay, but there are also other candles we want to pay attention to, which is highly important. These kind of candles. Okay, you look at this candle, you see that there is no wick at all. There are candles like this. This just tells you that there is a significantly strong trend in one direction. In this case, well, we're not going to translate it in this case, but we just want to know that we need a candle which is huge or big enough that has no wick at all, or little to no wick, and then we need a candle with a wick in both directions. Okay, so let's dive back into the Heikin-Ashi world. With that in mind, actually, let me also delete most of the drawings we just made right now. Remember, this strategy does not require you to know to have any technical knowledge of reading candlesticks at all. You don't need to know anything about reading candlesticks, and because the whole point here is that the Heikin-Ashi does all the work for you. They does everything, so that you are only paying attention to a few details, really a very few details. Okay, it's okay. I mean, it's okay if you know how to read this chart and all that. But if you do not know, that is perfectly fine. Let's take a look here. Let's grab this point. Let's grab whichever point ends up being clear here. Okay, let's grab this point here. Okay. Note that before we enter a trade, we want to be able to see clearly a trend which was coming from one direction, which is that trend is followed by a doji. Okay, but also we want to make sure that that trend was actually building a stairs. Either can build a stairs up, to the upside, or can build a stairs to the downside. A stairs to the downside just tells us that we are at least trending down. Okay, a stairs to the downside it's something that looks like this. We have that doji over there. Okay, and then we have that stairs. We have this that drops here. We have this that drop here, and then we have that which drops there. Okay, that is a stairs, and of course then followed by a doji. Okay, and of course when we see a doji here is just indicating that we have hit, or we have reached the reversal point. Okay, and then at that point we see that doji is picked up by a huge candle which is bullish enough. It has no wick. Remember, we mentioned that we're going to be focusing on these two candles only. A candle with little to no wick, and then a candle with wick. A candle with wick, we're using that for entry and exit. A candle with no wick at all, or little to no wick, we're using that for staying in a trend. We just want to make sure that we are at least building a stairs. In this case, our stairs happens to be, this is our entry. Okay, stairs there, stairs there, stairs there, stairs there. But then look how this red one fails to build the stairs. Okay, that is your clear exit. That is your clear exit. So we have seen that consolidation. So if you wanted to enter another trade, you would have to wait. You see how each of this is building, consolidating, but also this consolidation is actually followed by those dojis in series. Okay, that is just like a spinning stop. We want to get out of that spinning stop, and there was some sort of trying to break out of that. But I'm sure that if we draw a line here and look to the right, oops, I'm opening something else somewhere. If we draw a line right here and look to the right, it should correspond to some level. Okay, right there. And you might see that this was actually a gap which the market opened right here, and this became the market high of that day. And okay, here it is. So you see the date corresponding to where I am pointing is 23. Okay, and then we see the next is 24. That 24 is a gap down. So there is a gap down here that makes this point right where we are the higher high of that date, and this right here is just corresponding to that higher high, meaning that price went up, hit that higher high, tested that level right there, and reversed. Okay, we saw a clear reverse. That reversal is what we would be waiting for. Let me go ahead and just remove most of the drawings. And to me, the way I really use this is, like I said, I look for these points here. I look for those points. Well, here there was not really a doji at all, but because the first candle formed without a wick at all, or little to no wick, that is already strong enough. And this is, remember, this is a 45-minute chart we're looking at right now. So meaning a lot of things, the time frame will be a lot shorter. Okay, not the time frame, the days will be a lot shorter. Here is one of those other examples. You need something like that. Once you see that, wait for it. Do not just enter because the colors change on the Heikin-Ashi. Wait for that. Once you see that, and you the next one forms up without a wick, the next one forms up without a wick, which is right here. This forms up without a wick. You hop in, and then you're staying in that trade. Well, this right here did showed up some wick in both ends, but I will show you how you can eliminate those as well, how you can still stay in the trade when you see those already. Previous day, not really easily, but that was, of course, support and resistance level. I mean, a resistance level at some point. So a breakup to that is what we are looking for. And right where my crosshair is, let me actually put a line right there. Right there, that is where you would want to be watching a breakout from. And that candle, you see how the wick breaks above that and the next one closes above it. The consolidation that you're seeing here is just a struggle to the of a breakout to the upside, and you want that, of course. So anyhow, let me show you one trick that I one thing that I use in addition to this Heikin-Ashi candles. What I like to do, let me turn on my indicator. I have a very specific indicator here. This indicator is just a whole moving average. Okay, this tells me that if a candle is showing me a certain behavior within a certain color, I have to just react to that. For example, here it's showing me green. The Heikin-Ashi is strong. There is no wick, and the next one formed up, and they're all above that. I am staying in that. Okay, and the chops, you see that the chops, I mean by the chops I'm referring to these consolidation zones. The consolidation zones, most of them always stay within the line. I am not going to touch that. The clear trend stay either above or below, and that is highly respected. There's one clear thing that I'm going to show you though. I normally don't use this a lot. I'm going to turn this off. But the one thing which is very important is what I call the open range breakout. I've talked about this so many times, like so many times. so many times. Okay, the open range breakout here, the goal here is that it's telling you when the day opened. Um, so for example, you will see a lot of candles painted in black. Those black candles, it's the first candle of the day. If we take a look at this point, the day opened with a doji, and that's just a clear reversal from whichever point it was. The previous candle was green, the next one is red. Even if it was green or red, it's a doji. A doji is just indicating a reversal at that point. So meaning, if the next one formed below that, we would be in a trade right away. Okay, we would be in a trade, and of course at this point, if we bring that guy up, you see that we break below, this formed about below the hull, and we just ride the trend. Same thing here, and that just the cycle repeats itself. The cycle repeats itself. You do not need to be in a technical at all. And I'm using this on Nasdaq or NQ. If we move out of NQ and say, for example, we want to use SPY that everybody uses, or I mean, not everybody uses, but the most popular one that a lot of people know. On SPY, you see how beautiful this translates. Okay, this is not an extended hours, but if I go ahead and put this on extended hours, for those of you who likes to have the extended hours, you see that the day that's open, and if you see here, I have these levels drawn. This was drawn actually ahead of time because of the previous trade. Normally when I'm taking like if I'm to take the next trade, I look at the previous day closing. Okay, I look at the previous day closing, which is actually not just a previous day closing, the previous day high, previous day low. In this case, I have these two zones drawn. Previous day high was that. Price open in between the previous day high and previous day low. And we came and checked the previous day high right there, but it got rejected right away. And we broke the open range breakout to the downside. Okay, that downside breakout was strong enough because the first candle, which was red, had no wick at all. That just indicates a very powerful trend. And with that in mind, you can scale this on a longer time frame, or you can scale this on a shorter time frame. A lot of people like trading on a 5-minute chart or on a 10-minute chart. I like to keep things in between, which is why I use the 7-minute chart. You're welcome. Here, if I put this on a 7-minute chart, though, you will see that we had that consolidation at the beginning. We want to clearly have a clear signal. At the beginning, we have candles which are forming up with wicks on both sides. That's just not a breakout at all. We want a direction without that wick, and that came again. I had it already marked. That came right here, and that because I use 7-minute. Yeah, that came right here and stayed in a trade for a little bit. I know this was quite a scary pullback, but that was kind of like where the stop loss was. Almost got booted out, but did not get booted out. And then we stayed in that as long as we did not close above this held moving average right here, the thick red line, red cloud, I mean. We will still stay in the trade, but that of course violates the fact that you have to exit on a hull, I mean on a doji, which would have been on this one particular spot here. So with that in mind, just know that when a hull, with that in mind, just know that when Heikin-Ashi candle, when a Heikin-Ashi candle forms a little to no wick on either direction of the open range breakout, buy. Okay, you want to buy. But the other way around, if a breakout, if you reach a point in the trend and you are at a spot where there's a lot of those wicks starting to form, exit your trade, because that is the end of that trend primarily. And to speak of it, you don't need the whole package. You just need a piece of pie. Okay, don't be greedy. This is simple. Practice it.